Welcome at the webinar prepared by KIELTYKA GLADKOWSKI KG Legal in the frames of our ISTART1 concept, which combines cross-border legal services and networking between European enterprises who need financing for commercial projects and development in such sectors as, for example, life sciences, biotech, longevity, HR tech, technology, gaming, defense. Elevator pitch is a simple textbook how to persuade potential investor to invest and to enter into a joint venture. The webinar also presents practical hints about the investment contract and crucial clauses that should be included there. Venture capital is a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. Venture capital generally comes from well-off investors, investment banks, and any other financial institutions. However, it does not always take a monetary form. It can be also provided in the form of technical or managerial expertise. Venture capital is typically allocated to small companies with exceptional growth potential, or the companies that have grown quickly and appear poised to continue to expand. Though it can be risky for investors who put up funds, the potential for above-average returns is an attractive payoff. For new companies or ventures that have a limited operating history, under 2 years, venture capital is an essential source for raising money, especially if they lack access to capital markets, bank loans, or other debt instruments. Key takeaways. Venture capital financing is funding provided to companies and entrepreneurs. It can be provided at different stages of their evolution, although it often involves early and seed round funding. Venture capital funds manage pooled investments in high-growth opportunities in startups and other early-stage firms and are typically only open to accredited investors. Advantages and disadvantages of venture capital. Venture capital provides funding to new businesses that do not have access to stock markets and do not have enough cash flow to take debts. This arrangement can be mutually beneficial. Business get the capital they need to bootstrap their operations, and investors gain equity in promising companies. There are also other benefits to a VC investment. In addition to investment capital, VCs often provide mentoring services to help new companies establish themselves and provide networking services to help them find talent and advisors. A strong VC backing can be leveraged into further investments. On the other hand, a business that accepts VC support can lose creative control over its future direction. VC investors are likely to demand a large share of company equity, and they may start making demands of the company's management as well. Many VCs are only seeking to make a fast, high-return payoff and may pressure the company for a quick exit. Types of venture capital. Venture capital can be broadly divided according to the growth stage of the company receiving the investment. Generally speaking, the younger a company is, the greater the risk for investors. The stages of VC investment are pre-seed. This is the earliest stage of business development when the founders try to turn an idea into a concrete business plan. They may enroll in a business accelerator to secure early funding and mentorship. Seed funding. This is the point where a new business seeks to launch its first product. Since there are no revenue streams yet, the company will need VCs to fund all of its operations. Early stage funding. Once a business has developed a product, it will need additional capital to ramp up production and sales before it can become full self-funding. The business will then need one or more funding rounds, typically denoted incrementally as Series A, Series B, etc. The venture capital process. The first step for any business looking for venture capital is to submit a business plan, either to a venture capital firm or to an angel investor. If interested in the proposal, the firm or the investor must then perform due diligence, which includes a thorough investigation of the company's business model, products, management, and operating history, among other things. Since venture capital tends to invest larger dollar amounts in fewer companies, this background research is very important. Many venture capital professionals have had prior investment experience, often as equity research analysts. Others have a Master in Business Administration (MBA) degree. Venture capital professionals also tend to concentrate on a particular industry. A venture capitalist that specializes in healthcare, for example, may have had prior experience as a healthcare industry analyst. Once due diligence has been completed, the firm or the investor will pledge an investment of capital in exchange for equity in the company. These funds may be provided all at once, but more typically the capital is provided in rounds. The firm or investor then takes an active role in the funded company, advising and monitoring its progress before releasing additional funds. The investor exits the company after a period of time, typically 4 to 6 years after the initial investment, by initiating a merger, acquisition, or initial public offering. One important difference between venture capital and other private equity deals, however, is that venture capital tends to focus on emerging companies seeking substantial funds for the first time, while private equity tends to fund larger, more established companies that are seeking an equity infusion or a chance for company founders to transfer some of their ownership stakes. Equity. Equity is the amount of money that would be returned to a company's shareholders if all the assets were liquidated and all of the company's debt was paid off in the case of liquidation. Equity is important because it represents the value of an investor's stake in a company, represented by the proportion of its shares. Owning stock in a company gives shareholders the potential for capital gains and dividends. Owning equity will also give shareholders the right to vote on corporate actions and elections for the board of directors. These equity ownership benefits promote shareholders' ongoing interest in the company. Private equity. Private equity is a type of investment in which the investors purchase shares in privately held businesses. Private equity describes investment partnerships that buy and manage companies before selling them. Private equity firms operate these investment funds on behalf of institutional and accredited investors. Private equity funds may acquire private companies or public ones in their entirety or invest in such buyouts as part of a consortium. They typically do not hold stakes in companies that remain listed on stock exchange. Private equity is often grouped with venture capital and hedge funds as an alternative investment. Investors in this asset class are usually required to commit significant capital for years, which is why access to such investments is limited to institutions and individuals with high net worth. Key takeaways. Private equity firms buy companies and overhaul them to earn a profit when the business is sold again. Capital for the acquisitions comes from outside investors. In the private equity funds, the firms establish and manage, usually supplemented by debt. The private equity industry has grown rapidly. It tends to be most popular when stock prices are high and interest rates low. An acquisition by private equity can make a company more competitive or saddle it with unsustainable debt, depending on the private equity firm's skills and objectives. In contrast with venture capital, most private equity firms and funds invest in mature companies rather than startups. They manage their portfolio companies to increase their worth or to extract value before exiting the investment years later. The private equity industry has grown rapidly amid increased allocations to alternative investments and following private equity funds' relatively strong returns since 2000. In 2021, private equity buyouts totaled a record of $1.1 trillion, doubling from 2020. Private equity investing tends to grow more lucrative and popular during periods when stock markets are riding high and interest rates are low, and less so when those cyclical factors turn less favorable. Reasons for joint ventures. Joint venture is a business arrangement in which two or more parties agree to pool their resources for the purpose of accomplishing a specific task. This task can be a new project or any other business activity. Each of the participants in a joint venture is responsible for profits, losses, and costs associated with it. However, the venture is its own entity, separate from the participants' other business interests. Here are the four main reasons why companies form joint ventures. So the first one is to leverage resources. A joint venture can take advantage of the combined resources of both companies to achieve the goal of the venture. One company might have a well-established manufacturing process, while the other company might have superior distribution channels. Second is to reduce costs. By using economies of scale, both companies in the joint venture can leverage their production at a lower per unit cost than they would separately. This is particularly appropriate with technology advances that are costly to implement. Other cost savings as a result of a joint venture can include sharing advertising or labor costs. Third one is to combine expertise. Two companies or parties forming a joint venture might each have different backgrounds, skill sets, or expertise. When these are combined through a joint venture, each company can benefit from the other's talent. And number 4, to enter foreign markets. Another common use of joint venture is to partner with a local business to enter a foreign market. A company that wants to expand its distribution network to new countries can enter into a joint venture agreement to supply products to a local business, thus benefiting from an already existing distribution network. Some countries have restrictions on foreigners entering their market, making joint venture with a local entity almost the only way to do business in the country. A joint venture gives each party the opportunity to exploit a new business opportunity without bearing all of the cost and risk. Joint ventures by nature are riskier than business as usual, and sharing the risk is a wise move. If the right participants are involved, the joint venture also starts out with a broader base of knowledge and pool of talent than any one party possesses on its own. For example, a joint entertainment venture set up by an animation studio and a streaming content provider can get off the ground more quickly, and probably with a better chance of success than either participant could alone. Some cons of a joint venture. Well, embarking on a joint venture requires relinquishing a degree of control. The vital decisions are being made by two or more parties. The companies involved must go into the project with the same goals and an equal degree of commitment. Extreme differences between the participants, company cultures, and management styles can be a barrier to success. Will the executives of an animation studio be able to communicate in the same language as the executives of a digital streaming giant? They might, or they might line up in opposing camps. Setting up a joint venture multiplies the number of management teams involved. If one party undergoes a significant change in its business structure or executive team, the joint venture can get lost in the shuffle. Types of private equity and venture capital investments. Let us firstly discuss angel concept, pre-venture capital. Angel investors give early-stage support to startup level type companies when institutional investors are not ready to invest yet. This involves a company which may have an idea but has not properly validated it yet and built it into a business. To raise funds, these companies will ask friends or family to financially back them. An investment size varies between more or less $10,000 to $150,000. Next, seed capital, venture capital. These companies have now at least somewhat validated their product or service with customers or convincing research. The money is typically used for product development and business expansion, and this is when the first full-time sales and marketing people get hired. An investment size can range between $250,000 and $2 million. Professional angel investors sometimes provide seed money either through a loan or in a return for equity in the future company. These investors are generally high net worth individuals and may come from the personal network of a startup's founder or founders. Angel investors often enjoy a hands-on role in helping develop a company from scratch. If the angel investor contributes less than $1 million, the money is usually in the form of a loan. For the entrepreneur, this can solve the problem of attracting sufficient seed money, given the reluctance of financial institutions and even venture capitalists to take on considerable risk. When contributing more than $1 million, an angel investor typically prefers seed equity and becomes a co-owner of the startup and the holder of the preferred stock with voting rights. Next, let us discuss growth, venture capital and private equity. At this stage, companies more likely have figured out where their product or service has a need in the market but may still be unprofitable. The fundraising is mainly for expansion, both for the team and the business. An investment size varies between $10 million and $50 million. Then the crossover, private equity. Investors at this stage are looking for companies that have sustainable business models and profitability. This funding may be used to expand into new international markets or develop multiple products or services. Listing on a stock exchange (IPO) may not be far. Investment size is between $50 million and $100 million. And the last type, the late stage or buyout, private equity, investors may be most focused on making these mature companies more efficient, making up their value, and then flipping them for a bigger multiple return. The company is very close to an exit, either listing on a stock exchange or getting bought out. Investment size depends, but could be millions into billions. Crafting an effective elevator pitch. The best way to show your business idea to possible investors is using an elevator pitch. An elevator pitch is a short explanation from 1 to 5 minutes maximum of your startup. The idea is to try get the interest of an investor in the time of an elevator trip. You need to have in mind that you are going to try to sell your idea to someone that is used to listen to a lot of business ideas, and normally they have very short time to interact with. But the finality is not only to sell your idea, but to generate interest in your project to get a longer meeting in the future. We must be able to summarize essential ideas and organize them in an attractive way. It is important to always put ourselves in the listener's position to know whether what we are saying is worth listening to. Create a hook to hold their attention and imbue every word with enthusiasm and conviction. These are 5 characteristics that are always present in these speeches to be a real success. And these are creativity, assertiveness, adapting the time, knowing the person you are talking to, anticipate questions that may arise in order to have the answers ready to answer them. An example of scheme to use for making your own elevator pitch will follow the following steps. First one is introducing yourself. Second, detecting the problem. Third one, assessing the market size. Here we talk about total addressable market, or TAM, which is a way to quantify the market size opportunity for a product or a service. Is the overall revenue opportunity that is available to a product or service if 100% market share was achieved. It helps determine the level of effort and funding that a person or company should put into a new business line. The concept of total addressable market is important for startups and existing businesses because the estimates of effort and funding required allow them to prioritize specific products, customer segments, business opportunities. Where there are potential investors and buyers of the business, company executives can use total addressable market to provide available value proposition. When a private equity firm intends to acquire a startup company, it can use total addressable market to estimate the revenue generation potential of a product or service offered by that company. Total addressable market takes into account the products and customer segments that remain untapped by the startup. The assessment helps to determine the actual size of the available market and the prevailing competition for the products offered by the startup. An investor should be objective in estimating the available market because an exaggerated value may lead to markets with less potential for growth. The ideal market for any entrepreneur is one with potential growth capacity. So, total addressable market stands for the sector's entire revenue opportunity. Then, serviceable addressable market stands for what percent of total addressable market is being served. And serviceable obtainable market stands for what percent of serviceable addressable market can be captured. Total addressable market, serviceable addressable market, and serviceable obtainable market represent the various subsets of a market. Total addressable market refers to the total demand for a product or service that is calculated in annual revenue. Serviceable addressable market is the target addressable market that is served by a company's product or services. Serviceable obtainable market is the percentage of serviceable addressable market that can be realistically achieved. Identifying these subsets within an industry requires some market research to understand the proportions of each area. Determining the proper moment for investment. Now, in this part, there should be defined the tendency of the market. If there is a bull or bear market. In a quite simple way, bull market is when there is a tendency of growing and the investors have confidence to invest their capital. Bear market is sort of the contrary, when there is a tendency of decrease and the investors do not have confidence. If the trend is up, it is a bull market. If the trend is down, It is a bear market. To identify a bull market, there are several characteristics that can be observed. These include an increase in trading volume, as more investors are willing to buy and hold onto securities in the hopes of realizing capital gains. Securities in a bull market also tend to receive higher valuations, as investors are willing to pay more for them due to the perceived potential for price appreciation. In addition, a bull market is often characterized by greater liquidity in the market. Normally, there is no specific and universal metric used to identify this type of market, but perhaps the most common definition is a situation in which stock prices rise by 20% or more from recent lows. On the other hand, the bear market is when a market experiences prolonged price declines. When the prices fall 20% or more from recent heights, amid widespread pessimism and in negative investor sentiment. The causes of a bear market often vary, but in general, a weak or slowing or sluggish economy, bursting market bubbles, pandemics, wars, geopolitical crises, and drastic paradigm shifts in the economy, such as shifting to online economy, are all factors that might cause a bear market. The signs of a weak or slowing economy are typically low employment, low disposable income, weak productivity, and a drop in business profits. In addition, any intervention by the government in the economy can also trigger a bear market. Attending our necessities, you must be aware of the circumstances of the market in general, but also pay attention to the sector related with your business idea, not only in an economic way of thinking, but technological and social, perhaps, view too. Explaining strong points and differences with the competitors. A great way to get to know your idea, its strengths and weaknesses, is by doing a SWOT analysis. A SWOT, that is strengths, weaknesses, opportunities, and threats, is a framework used to evaluate a company's competitive position and to develop strategic planning. It has in count internal and external factors, as well as current and future potential. A SWOT analysis is designed to facilitate a realistic, fact-based, data-driven look at the strengths and weaknesses of an organization, initiatives, or within its industry. The organization needs to keep the analysis accurate by avoiding preconceived beliefs or gray areas and instead focusing on real-life contexts. Companies should use it as a guide and not necessarily as a prescription. Every SWOT analysis will include the following 4 categories, though the elements and discoveries within these categories will vary from company to company. A SWOT analysis is not complete without each of these elements. So firstly, strengths. Describe what an organization excels at and what separates it from the competition. A strong brand, loyal customer base, strong balance sheet, unique technology, and so on. For example, a hedge fund may have developed a proprietary trading strategy that returns market-beating results. It must then decide how to use those results to attract new investors. Weaknesses. Stop an organization from performing at its optimal level. They are areas where the business needs to improve to remain competitive. A weak brand, higher than average turnover, high levels of debt, an inadequate supply chain, or lack of capital. Opportunities refer to favorable external factors that could give an organization a competitive advantage. For example, if a country cut tariffs, a car manufacturer can export its cars into a new market, increasing sales and market share. And threats refer to factors that have the potential to harm an organization. For example, a regulatory ban is a threat to cannabis producing company, as it may destroy or reduce the crop yield. Other common threats include things like rising costs for materials, increasing competition, tight labor supply, and so on. In the elevator pitch, the focus should be put on the strength and avoiding the weaknesses. It should mention the strength comparing with the competitors, but without mentioning them directly. Understanding your business model. In this part, you need to identify the business model. In other words, how are you going to make money? Just to put some examples. Is that a product or a service? Is it an one-time business or is it a type of subscription or recurring business? Do you produce the goods yourself, contract other company to make them, or you buy them from another company, and so on and so forth? Some methods can help you with this matter, and these are ARR, annual recurring revenue, gross profit, and ARPU, average revenue per user. ARR is the measure of recurring revenue on an annual basis. It should exclude on-time fees, professional service fees, and any variable usage fees. Essentially, annual recurring revenue is a metric of predictable and recurring revenue generated by customers within a year. The measure is primarily used by businesses operating on a subscription-based model. Principal uses. First one, it quantifies the company's growth. The predictability and stability of annual recurring revenue make the metric a good measure of a company's growth. By comparing annual recurring revenues for several years, a company can clearly see whether its business decisions are resulting in any progress. Secondly, evaluate the success of the business model. Annual recurring revenue enables a company to identify whether its subscription model is successful or not. And third one, forecast revenue. The metric is commonly referred to as a baseline, and it can be easily incorporated into more complex calculations to project the company's future revenues. Gross profit is equal to total revenue minus the cost of goods sold. It's a company's total profit before subtracting its operating expenses, interest and tax payments. Gross profit shows the overall financial success of products or services, as it reflects a company's income prior to overhead expenses. It can also be used to calculate a gross profit margin, which is essentially the percentage version of gross profit. The gross profit margin is used for comparison purposes, such as measuring a company's production efficiency over time or comparing to the industry average to measure performance amongst the market. Average revenue per user is the total revenue divided by the number of users for a specific time period, like month, quarter, or year. It demonstrates the value of users on your platform. While average revenue per user was originally primarily used in the telecom industry, it has become useful for all types of digital businesses, from SaaS providers to social media networks to mobile apps. Average revenue per user is calculated by dividing your revenue by your number of users over the time period you want to measure, such as a week, month, or year. Average revenue per user is most commonly measured on a monthly level using monthly recurring revenue, MRR, as an input. So average revenue per user equals monthly recurring revenue per number of active users. Another metric closely related to average revenue per user is average revenue per paying user, and this is ARPPU. This is calculated the same way as average revenue per user, but only includes paying users. For apps using a freemium monetization model, distinguishing between and comparing these two metrics is important, as in this case, an app's average revenue per paying user should be significantly higher than its average revenue per user. The idea is to explain how your business works so the potential investors can understand better the situation and the pros and cons of your idea. Essential business metrics. This part is about numbers. Here are some ideas of the metrics that you can use. Now, first one, CAC, that is customer acquisition cost. Should be the full cost of acquiring users stated on a per user basis. One common problem with customer acquisition cost metrics is failing to include all the costs incurred in user acquisition, such as referral fees, credits, or discounts. Customer acquisition cost equals sales and marketing expense, number of new customers. Second, LTV, lifetime value, is the present value of the future net profit from the customer over the duration of the relationship. Lifetime value equals average revenue per user multiplied by gross margin, churn rate. Customer lifetime value is one of the metrics used to measure the growth of a company. By comparing the lifetime value of a company to the cost of customer acquisition, there can be calculated the value of a customer to the business over the period of time that they were associated with. The lifetime value helps a company gain and retain highly valuable customers. Next one is the churn rate. There is all kinds of churn, like dollar churn, customer churn, net dollar churn, etc. In short, churn rate shows the frequency at which your customers leave your business. Investors look at it the following way. Monthly unit churn equals lost customers, prior month total. Churn rate can impact your business growth. Ideally, businesses want to minimize churn in order to retain customers and maximize profits. As a result, companies will work on both customer retention and the acquisition of new users so that they can grow. Without these two factors, it will be difficult for business to succeed. Since churn rate and growth rate can go hand in hand, it is essential that businesses consider new customers as well as how many clients leave. This allows companies to assess total growth. If the growth rate is larger than the churn rate, then the business has expanded its customer base. Now, next one, it's a burn rate. Burn rate is the rate at which cash is decreasing. Investors tend to focus on net burn to understand how long the money you have left in the bank will last for you to run the company. Burn multiple equals net burn, net new annual recurring revenue. A startup is often unable to generate a positive net income in its early stages as it is focused on growing its customer base and improving its product. As such, seed stage investors or venture capitalists often provide funding based on a company's burn rate. Next one, active users. Now, different companies have almost unlimited definitions for what active means, since it really varies by company and depends on the business model. It is especially useful when the business consists in services or a digital application. When measuring your active users, the following has to be kept in mind. Now, firstly, you have to clearly define it. Next, you have to make sure it is a true representation of activity on your platform. And 3, you have to be consistent in applying that definition. Now, we can have daily active users, DAU. So daily active user is someone who interacts with an app on a specific day, like for example, January the 1st. Now we can have weekly active user, WAU. A weekly active user is someone who interacts with an app over a period of 7 days. For example, from the 1st to 7th January. Monthly active user, MAU. Now, monthly active user is someone who interacts with an app over a period of 30 days. For example, from the 1st to 31st of January. The usefulness of each measurement period depends on an app's vertical. While it is beneficial to maintain a healthy number of daily active users, an app that is based on seasonal or occasional usage, such as a last-minute hotel booking app or a banking app, might place more emphasis on monthly active users. Monthly active users is an important metric for many businesses because it is another indication of whether their retention rate is healthy. Now, next we have virality. Now, this is the speed at which a product spreads from one user to another. Virality is often measured by the viral coefficient or K value. How much users of a product get other people to use the product? Average number of invitations sent by each existing user. Conversion rate of invitation to new user. Like example is the TikTok. Then we have customer concentration risk. This is defined as the revenue of your largest customer or customers relative to total revenue. If your largest customer pays you like $3 million per year and your total revenue is $30 million per year, then the concentration of your largest customer is 10%. Investors prefer companies with relatively low customer concentration. If you find yourself concerned that the majority of your accounts receivable comes from a small number of large customers, then it is time to ask yourself the question, what would happen if you lost your biggest client or if your industry got hit with an economic downturn? Understanding your current vulnerabilities will help you manage and mitigate the revenue risks you may face down the line. Team overview. In this part, you should describe your team. Now, maybe this does not look so important as other parts of the elevator pitch, but in reality, the potential investors pay a lot of attention to the human capital. The investor needs to know that the people that are going to receive the capital are capable of doing what they are saying that they do. In addition, it is very interesting to highlight if some part of the team have experience with previous startups and projects. One has to underscore the studies, experiences, and every point that can be useful to the project and to receive investment. This part we talk about roadmap and goals. So we have short-term goals and long-term goals. Short-term goals. It means to secure initial investment through early-stage funding rounds like pre-seed, seed, and Series A. Progress can be obtained through later stage funding rounds, Series B and C, to expand on a larger scale, proving the company's readiness for success. The next goal is to develop technical and managerial expertise by leveraging both financial and non-financial investments. They aim for a solid market presence with a view towards preparing for an initial public offering. And next is to establish a clear commercial strategy to secure a stable market position and build a substantial user base. To establish strategic joint ventures or partnerships to enhance market reach, access new technologies, and share development risks. This part focuses on post-investment collaboration structure. After a successful round of meetings and chats with potential investors, you may get one interested in your idea that wants to invest in you. And there's the question, how is the investment structured? In which ways can it come? What do I have to give in return? These are some questions that you surely are going to need to respond. The investor requires a series of guarantees to ensure that despite the high risk involved in this type of investment, he or she has some certainty that they will be able to achieve the expected return. It is therefore not surprising that joint ventures are sometimes formed, or that the capital provided is not always monetary but human capital. The investor will help you to take the idea or the business forward because it is beneficial to them. Normally, this collaboration is structured in a series of contracts that are successive and juxtaposed. Not necessarily all contracts have to follow Polish law. We work with many foreign investors from the USA, the United Kingdom, and usually in the early stages they follow Polish law, but later on in certain aspects the US or British law can be used to regulate the investment relationship. In this part, we talk about types of investments, and that would be focused on financial investments and non-financial investments. An investigation can come in a wide range of manners depending on the stage of the startup. If this is a pre-seed, seed, or early stage, and the type of project itself. So, firstly, we can describe technical or managerial expertise. This investment can come in the form of technical staff with expertise in the sector or activity, as well as management staff to help with the administration of the company. This staff can come either directly from the company or investor, or the investors can help you in the task of finding new employees on the job market. Next, there is cash flow. The principal way of investing is by financing through injections of capital. It is important to mention the series funding A, B, and C. Before a startup can make an initial public offering, IPO, that is, enter in the classical market of stocks, startups need financing of private investors, and this is normally structured in various rounds, known as Series A, B, and C. These rounds are normally to exchange of cash and equity or partial ownership of that company. There are other types of funding rounds available to startups, depending upon the industry and the level of interest among potential investors. We can talk about pre-seed in the earliest stage of the business. Usually the idea is under development and the financing comes from the own founders or from families and friends. However, this does not mean that it cannot come from an external investor. Second is seed. Seed funding helps a company to finance its first steps, including things like market research and product development. Generally, there are so-called angel investors, the ones who made this type of financing. Next, we have early stage. During this stage, the startup is going to get a more or less secure initial position in the market with a commercial strategy and searching to get as much clients as possible. Normally, it would start searching for investment with new partners further away than family, friends, and the angel investor. Then we have Series A, when the startup is more or less established. With a good idea and a strong strategy, there is a time for Series A funding. By this stage, it is also common for investors to take part in a somewhat more political process. It is common for a few venture capital firms to lead the pack. In fact, a single investor may serve as an anchor. Once a company has secured a first investor, it may find that it's easier to attract additional investors as well. Typically, Series A rounds raise approximately $2 million to $15 million. Series B, this is the next level from A. Normally, at this stage, the company has developed substantial user bases and has proven to investors that they are prepared for success on a larger scale. The major difference with Series B is the addition of a new wave of other venture capital firms that specialize in later stage investing. In Series C, this is the third and usually the last round of private financing before an IPO. At this phase of development, the business has a solid base in the market. Because of that, the number of investors interested in the company is larger. The risk is smaller than in previous stages. In this part, we are going to discuss joint ventures in detail. Sometimes the investment translates into a joint venture. We already have defined what a joint venture is. Occasionally, the investor is a bigger company of the sector or that has presence in other markets and wants to introduce itself to a new one. For this reason, creating a joint venture is the most logical thing for the investor. For example, the startup makes the development and investigation about a new product or service, and the investor, a larger company with more economic resources, owns the facilities and manufacturing production that a startup needs to produce and sell its products. A company enters into a joint venture because it lacks the required knowledge, human capital, technology, or access to a specific market that is necessary to be successful in pursuing the project on its own. Coming together with another business affords each party access to the resources of the other participating company without having to spend excessive amounts of capital to obtain it. Unlike a business merger or an acquisition, a joint venture is a temporary contract between participating companies that dissolves at a specific future date or when the project is completed. The companies entering into a joint venture are not required to create a new business entity under which the project is then completed, providing a degree of flexibility not found in more permanent business strategies. Also, participating companies do not need to give up control of their businesses to another entity, nor do they have to cease ongoing business operations while the joint venture is underway. Each company is able to maintain its own identity and can easily return to normal business operations once the joint venture is complete. Joint ventures also offer the advantage that exposure to problems is spread among the participating companies. Creating a new product or providing a new service involves a great deal of risk for a company, and many companies are not capable of managing that risk on their own. In a joint venture, each company contributes a share of the resources needed to bring the product or service to market, which makes the heavy financial burden of research and development less of a challenge. The risk of the project failing and having a negative impact on profitability is lower because the costs associated with the project are distributed among each other of the participating companies. In this part, we are going to discuss the roadmap and phases of the collaboration, including contractual agreements in venture capital and private equity. There are many variants of the basic deal structure, but whatever the specifics, the logic of the deal is always the same: to give investors in the venture capital fund both ample downside protection and a favorable position for additional investment if the company proves to be a winner. In the contract or series of contracts, the investor gives a list of milestones to reach with the reward of injections of capital. A good contract will bring clauses to guarantee that both parties accomplish their part of the agreement. Normally, two agreements are made. The first agreement contains the issues related to the injection of capital, milestones, transfer of equity. The second one is about the intellectual property. Basically, in the first agreement, there are included all aspects of the investment except intellectual property. That is the main issue of the second contract. Generally, the first contract is going to be based on the selected law, like in Polish in our case, and the second one can be a foreign law, American or British. Furthermore, as there is freedom of form in the agreement and circumstances in the real world can vary greatly, so can the content of the agreement. For example, the first agreement mentioned can be a combination of contracts. A good contract to guarantee the rights, duties, obligations of the parties should contain the following sections. For example, the first, definitions and interpretation. For the avoidance of doubt, it is preferable to devote a section to defining the terms to be used in the contract so that there is no misinterpretation. Transaction details. Basically, this is where the transaction to be carried out, the investment between the parties, will be recorded. For example, a series of Series B shares will be created for the value of $1 each. These will be acquired by the investing party. A joint venture will be created. The capital of the party receiving the investment will be increased in one way or another. Next, conditions precedent. This section will record all previous actions that have been taken by the parties prior to and in pursuit of agreeing the contract. For example, status of dissatisfaction, anti-monopoly clearance, registration procedures. Next, we have founders' covenants prior to registration date. The warranties, deals that the founder shall maintain during the period of time between signing the contract and its entrance into force. For example, the company must not sell any shares until a certain date or make a merger, division, or transformation. Then we're going to have closing and post-closing. This is when the transaction is considered completed. The investment received the capital injection, and the actions shall be taken by the parties after the transaction, such as filing the relevant registrations with the public authorities or providing the other parties with evidence that the transaction has been completed, possible new agreements and targets for future extra capital increases, new board compositions, the creation of new series of shares, etc. Then we have issues concerning corporate governance. Here, the parties establish the administration of the company, how it is formed, sets the actions that are to be taken, such as that the investing party provides administration and consulting personnel to the party that receives the investment, the number of people on the table, the voting methods, the necessary quorum, shareholder meetings, the existence of supervisory table and its powers. How the taxation and fiscal year will be carried out. The rights of access to the information, etc. Next point, description of transfer of shares. This section contains the regulation of the transfer of shares, such as the prohibition of selling the shares to third parties, the right of first refusal, tag-along right, drag-along right, liquidation preference, contractual penalties, etc. Next one, founders' warranties and investors' warranties. As its name suggests, there is included a list of warranties that the founder and the investor give each other to safeguard the agreement. Next one, rules and limitations of liability. Normally, this type of operations are fulfilled by limited liability companies. In the contract, it is usually contained that the liability in claims from one party against the other shall be subject to the general principle of Polish law in the discussed case, relating to breach of contract, as well as general exemptions, thresholds, liability period, claim notice, remedy period, notification, etc. Next, we have non-competition clause. In order to ensure the cooperation and to avoid problems, a non-competition deal can be made. This type of deal is a base that both parties or a selected party can be in a different degree of restriction and shall not, anywhere in the defined territory and in any form, directly or indirectly, on their own account or on the account of any defined third party, individually or jointly with others, conduct with regards to the established company any form of competitive activity without prior written consent of the other party, as long as they hold shares in the established company. To continue, next clause can be investors' right to rescind. There can be included the possibility of rescinding the investment in case of the occurrence of some defined circumstances that have to be contained in the agreement that make the investment unsatisfactory to the investor, acting commercially reasonably, and in the situation the other party does not implement the solutions proposed by the investor. Next one, confidentiality clause. Basically, the standard is to have a confidentiality clause in order to protect the information about the provisions of the agreement, the negotiations related to the agreement, the subject of the agreement, the investment value, the specifics of the company and its business activity, as well as information about the parties. Next one, notices. It is reasonable to create a mechanism to cause that all parties of the agreement receive effectively any notices important to the agreement, the investment, or the cooperation. Next one, assignments. Generally, in this type of contracts, the transfer of rights and/or obligations can be only made prior consent of the other party, and normally the consent has to be granted in full and be direct and not presumed. There needs to also be indicated the form and specified conditions of the transfer of rights and duties under the contract. Next one, amendments and entire agreement. This contractual clause specifies that the contract supplants and takes precedence over any prior agreements, arrangements, or negotiations, and the parties shall only rely upon it. Next one, costs and expenses, severability, governing law, and arbitration. In any business agreement, there shall be contained the manner the costs of concluding the agreement are divided, a provision applied in case that a part of the agreement is no longer valid. The applicable law that rules the agreement, that is governing law. It may contain a clause providing for arbitration in any particular jurisdiction, as well as the choice of proper court and the counterparts that the agreement had been executed. Next one, term of the agreement. There shall be defined the date of the entry into force and the circumstances leading to the expiration of the agreement. The contract can be for a defined time, for an unlimited time, or in order to reach certain results. Then we have annexes. The annexes to the contract may contain any documents related to the agreement, the investment, the parties, the collaboration between the parties, any prior documents to the agreement, as well as any documents that may be important to the agreement. These all are some of the most often used provisions and clauses in the investment agreement. Depending on the circumstances, the contract can be shorter and simpler, but a shorter and simpler contract can have legal loopholes, and when one is working on such an important operations involving large sums of capital, one does not want to have these kinds of insecurities and doubts that can lead to problems or conflict in the future. It is advisable to leave everything well tied up, but of course, the particular clauses and solutions should be adapted to a specific situation and investment. When the party finds itself in such a situation, a contract should be drawn up according to specific needs and circumstances. The second agreement negotiated and concluded in investments regards intellectual property transfers. The term intellectual property refers to the protection of the product of human intellect, whether in the scientific, literary, artistic, or industrial fields. Such protection grants creators, authors, and inventors a temporary right to exclude third parties from appropriating knowledge generated by them. Intellectual property protection depends on the specific country's domestic law. Nevertheless, there are some categories that are similar, more or less, in the countries of our legal environment. First one, we have patents. A patent is a property right for an investor that is typically granted by a government agency. Depending on the jurisdiction, there are the following types of patents. Utility patents. They are used to protect how a product works and features which enable it to work. Patents can cover products, processes, methods, software, apps, or new uses or combinations of existing products. To create one of these utility patents in the US, for example, you can extend a home country patent application to the US or file a direct US patent application. US utility patents are examined for novelty and inventive step. In other words, whatever you want to protect must be created before it. Now, design patents. It is used to protect the shape or decoration of a product. It does not protect features of a design which are solely dictated by the product's technical function. Freedom to operate. Filing a patent application does not give you the right to do anything. It gives you the right to stop others from doing something. For this reason, there must be undertaken patent searches for third-party patents prior to product launch. Design around any problem of the patents. Patent invalidation. Watching any patent applications, which may be an issue if granted. Next, we have copyrights. It is the legal right of the owner of intellectual property. Copyrights provide authors and creators of original material the exclusive right to use, copy, or duplicate their material. A copyright also states that the original creators can grant anyone authorization through a licensing agreement to use the work. Trademarks. They are used to protect the brand or product name, for example, words, letters, numerals, logos, shapes of goods, or their packaging, sounds, colors, etc. You need to register your trademark in every country you are present. In the European Union, the responsibility to make EU trademark that brings you protection in all member states. Franchises. It is a license that a company, individual, or a party purchases, allowing them to use a company's name, trademark, proprietary knowledge, and processes. This means that the owner of the license has the right to sell a product or service under the company's name, and in return, he or she must pay a startup fee and ongoing licensing fee to the company. Trade secrets. It is a company's process or practice, know-how, that is not public information, which provides an economic benefit or advantage to the company or holder of the trade secret. Trade secrets must be actively protected by the company and are typically the result of company's research and development. Examples of trade secrets could be a design, pattern, recipe, formula, or proprietary process. Now, issues to consider when drafting a good intellectual property transfer contract. The main contents of the contract can vary according to the intellectual property right that is going to be transferred. But in general, the party or parties that are assigning rights as well as the party or parties that are receiving the rights need to be identified and described. Next, the rights that are being transferred must be identified, defined, and described. The marking of the effective date of transfer needs to be specified. The representations and warranties of the parties need to be included. Provisions on post-assignment obligations may need to be inserted. We need to have in mind, taking into account these specificities, we can outline the necessary contents of an IP transfer contract. Namely, first, definition of the IP, next, duration of the license, next, territory for which the license is granted. Furthermore, indication of whether the license is exclusive, non-exclusive, or sole. Then, right to use improvements, how to deal with upgrades of the licensee over the IP. Furthermore, license initiatives such as the benchmarks and what happens if they are not met, as well as defining minimum royalties. Then we have termination, next royalty provision, then sub-licensing if it is granted, next infringement procedures, then confidentiality clauses for negotiation, the contract itself or trade secrets and know-how, and costs and expenses, severability, governing law, and arbitration and counterparts. Now, it is also worth mentioning what happens with intellectual property in the joint ventures mentioned above. An agreement on IP rights in a joint venture should be based on planning to maintain distinctiveness of the brand, foresee the retention of property rights by each brand holder once the joint venture agreement is over, planning an adequate monitoring and quality control provisions to help reduce the risk of a loss of control by the brand holder and dilution of the trademark. There should be developed a marketing plan setting out how and through which platform to promote and market the services or products, defining the scope and use of the brands, and foretell the liability and indemnification for defective products. In this part, we are going to focus on business accelerator and incubator firms. A business accelerator firm is an organization engaged in the business of fostering early-stage companies through the different developmental phases until the companies have sufficient financial, human, and physical resources to function on their own. They can be either a non-profit or for-profit entity, and it can provide assistance via any or all of the following methods. Access to financial capital through relationships with financial partners. Next, access to experienced business consultants and management-level executives. Furthermore, access to physical location space and business hardware and software. And access to information and research resources via relationships with local universities and government entities. The business accelerator and incubator firms operate with the idea of helping small firms grow. They work with early-stage startups that do not have a business model in place or that have one, but in early stage. They help nurture a startup by developing its strong idea into a viable product and are commonly referred to as a school for startups. Incubators typically work on a fee basis or taking an equity stake in the startup. They work on an open-ended time frame. There is no set schedule or period in which they deem that a startup is ready to launch. They create an environment in a co-working space for an exchange of ideas with a multitude of selected companies that are all share overhead costs, which helps foster collaboration and the growth of relationships with like-minded individuals. The startups chosen for the program can expect to work with advisors and mentors who will offer their experience in the business world to help address questions and dilemmas they face. Incubator firms might put these startups through classroom-style sessions, wherein the teams must perform tasks such as gathering feedback from potential customers about their product. Throughout the accelerator incubator process, the startups will be pushed to improve their ideas and learn how to convey their plans to customers and potential investors alike. It is not uncommon for startups to pivot during an incubator program after conferring with seasoned experts and testing their product or service with the public. At the end of a cohort's program, the startups will often present their business plans at a demo day session. Such an event brings together potential investors and other entrepreneurs who may wish to collaborate with or back the development of the startup. Thank you very much for your attention. And if you have any questions or queries regarding investments, contracts, private equity or venture capital, or any related issues, please contact us via email at office@kg-legal.pl. Thank you very much.